You ever wondered why the rich seem to evade paying taxes? Many do this by playing the real estate game and specifically using something called depreciation as their secret weapon. The government actually incentivizes land and building ownership and gives out two golden tickets within the tax code: depreciation and bonus depreciation, which actually can reduce your taxes over time. But it doesn't stop there. There's also something called a cost segregation study, which actually allows investors to dial up their depreciation benefits by breaking down their property into components with different lifespans. Pair this with bonus depreciation that allows you to claim depreciation for a significant portion of your property costs in the first year. And now, my friend, you've got a powerful tool. It's all about playing the game smart, which is exactly what we're going to discuss in this video. And if you're new here, I'm Dr. Jeff Anzalone. I'm not a tax expert, just to parent honest, on a mission to get you out of the rat race and paying as little taxes as legally possible. If you're new here, download the free passive income guide below the video. Now, if you decide to invest in real estate, then you're quickly going to realize that you'll potentially face several costs, such as the purchase price of the property, renovation expenses, land improvements, just to name a few. Fortunately, there's something called a cost segregation study. All right. Now, this is going to help you reduce your tax liability and free up cash for future investments. This strategy also accelerates the depreciation of certain building components, enabling investors to claim additional depreciation deductions on their tax returns. Now, I know this sounds a little bit confusing. So what exactly is a cost segregation study? Now, this is nothing more than a tax strategy that breaks down a building or an asset into various components, such as structural components, personal property assets, land improvements, and leasehold improvements. So basically, instead of looking at a property as a whole, it segregates it out into different components. Now, after they do this, investors can accelerate their depreciation expenses, which is basically the wear and tear on the property. The IRS allows us to write off the wear and tear of a property, okay? So, cost segregation study allows you to accelerate these depreciation expenses, thus lowering the tax liability by assigning shorter recovery periods to the specific components, such as electrical wiring, plumbing fixtures, flooring, etc. All right. So let's talk a little bit about how this actually works. Let's use an example. Okay. So suppose that you buy a commercial building for $2 million. Without cost segregation, the IRS allows you to spread out the cost. It's called straight line depreciation, to spread the cost out of the building over a 39-year period. This is like taking your building and slicing it into 39 equal parts. Each year, you get to deduct one of those parts, which comes out to being $51,282. How did I get that? I took $2 million and I divided by 39, which gives us that total. All right. So each year you get to deduct that amount from your income before you calculate your taxes. So for instance, if you're in the 35% tax bracket, then that is going to save you about $18,000 a year in taxes. All right. Cost segregation is nothing more than a fancy way of saying that you get to look at your building in detail and then separate or segregate it out into parts that have a shorter useful life. For instance, personal property like furniture or improvements made to land or a parking lot, that's an example. All right. So let's say after a detailed look, you get this cost segregation study, and now that you find in your $2 million building, you find $500,000 of that $2 million. So $500,000 of the building's purchase price is actually able to segregate out into these shorter life items. So now, instead of spreading your property out and depreciating it over 39 years, cost segregation study lets you to do it much quicker, over 5, 7, or 15 years. All right. So let's say they're able to go in and figure out that of the $500,000, it could be shorter life property over 5 years. So that's $100,000 a year over 5 years. All right. So if they choose to spread it out over 5 years, that's like slicing the $500,000 into 5 equal parts, which gets us the $100,000. If they went in and saw it was more 7-year property, then it would be $71,429. So 500,000 divided by 7 is that. Last but not least, if they were able to see it was all 15-year property, then 500,000 divided by 15 is $33,333. Okay, so let's take, so for instance, we're going to stick with, to make things easy, numbers easy, we're going to say of the $500,000 we figured out we could speed up depreciation over 5 years, $100,000 a year. Okay, the remaining, so we had 500,000 of the $2 million, so that's gonna leave us with $1.5 million, right? The remaining $1.5 million of the building's cost minus the segregated cost, $500,000, it continues to be depreciated over the 39 years, right? So we take out the 500,000 from the 2 million. So we have 1.5 million divided by that 39 years. Those 39 equal slices, okay? This results in an annual depreciation of $38,462. All right, take this and you add it to the short life properties annual depreciation. Remember, we're going to use the 5-year example. So the 38,462 plus the 100 gives us $138,462. Applying that 35% tax rate, it's going to lead to an annual tax savings of $48,462. So cost segregation allows you to basically save more in taxes by taking larger deductions sooner. That's it. That's it in a nutshell. All right. So we talked about cost segregation. Now to kick it up a notch even more, there's something called cost segregation. This was the golden ticket number 1. Golden ticket number 2 is something called bonus depreciation. Now, this is a deduction that allows a taxpayer to take 100% deduction in the year that the asset is placed into service. So think about this, by utilizing this, real estate owners are allowed to depreciate items with less than 20-year life immediately in year 1. Now, this applies to both new and used property. All right, new and used property, these leasehold improvements, qualified improvement property, qualified retail improvement property, things like that. Now remember, you may or may not know this, it's a side note, currently in this administration, bonus depreciation is being phased out. So starting in January of 2023, so from 2017 to 2022, you were able to take 100% bonus depreciation. Now it's going to be phased out 20% each year. So for instance, then it goes down to 80%, 2023, then it goes to 60% in 2024, so on and so forth until it's phased out. But there are talks that it may not be doing that. So again, we won't know to the future. We're not worried about that. We're just going to look at what we're being offered now, and that's where our focus is, okay? Now, again, cost segregation is a very valuable tax planning tool that, remember, it provides additional tax deductions to you if you're a real estate investor. If you're like me, you're busy with no time to dealing with tenants whenever you're owning real estate, then you may want to consider something called a real estate syndication, which is a passive way to invest in real estate. So these group investments, they'll allow you to invest for passive income while still enjoying the benefits that real estate provides. Cost segregation studies and bonus depreciation is still used with these investments. And if you want to learn more about how they work, check out this video.